Hello, and thank you for joining R Street's webinar on alternative investments and defined contribution, mainly 401k plans. A recent Gallup poll done in the spring of this year found 63% of respondents worried they won't have enough money to retire. This was the highest percentage recorded for that in a decade. Since the spring, when the survey was done, the S&P 500 has fallen by 17%, the Dow by 12%, so we can imagine the percentage of Americans now feeling they won't have enough savings or income to retire could be 75% or even more. That's an alarming number. It's probably caused many to rethink their retirement age and push it further out into the future. 67 years of age is already the new 65. So what'll it be now? 70? 72? I'm Jerry Theodorou, Director of the R Street Institute's Finance, Insurance, and Trade Program. R Street is a Washington, D.C.-based nonpartisan think tank engaged in public policy research and outreach to promote free markets and limited effective government. Joining me today are my R Street colleague, former investment analyst, R Street resident fellow, Caroline Millier, and our featured special guest, sharing his expertise on our topic, Jesse Fay, Vice President of Private Capital at investment data provider Prequin. Thank you, Caroline. Thank you, Jesse. It's great to see you and to hear you today. The solution to the retirement asset challenge that we'll explore involves allowing 401k plans to include investments in alternative asset classes. What do we mean by alternative asset classes? The vast bulk of assets held in 401k plans are in public stocks, bonds, and cash. Those are the big three: stocks, bonds, and cash. These we call traditional asset classes. Alternative assets, by contrast, include private equity, hedge funds, real estate, infrastructure. And the reason we're looking at them is because they have historically generated superior returns when compared to traditional investments. It's important to understand that there are differences between traditional and alternative investments. Traditional investments are highly regulated, mainly by the Securities and Exchange Commission, the SEC. Alternative investments are much less regulated. Traditional investments are highly liquid. One can get out of a stock as easily as get into it. As Will Rogers once said, if a stock is going to go up, buy it. If it's not going to go up, don't buy it. It's as easy as that. Alternative investments are less liquid. Traditional investments are highly correlated with movements in the capital markets. Alternatives have less correlation with changes in stock and bond markets. Traditional investments don't use leverage. Alternative investments do make use of leverage. Traditional investments are open to the public, whereas alternatives are typically only available to sophisticated, accredited investors and institutions aware of the characteristics and risks surrounding alternatives. And there's growing interest today in alternatives because above and beyond its potential to generate superior returns, it could be a hedge against inflation, which has come to haunt us. And before we dive into the numbers and Jesse sets the table for us, let's hear about some regulatory considerations. Caroline, would you like to say some things about how the government is involved in this business through the Department of Labor?
Yes, and thank you, Jerry, for having me on the webinar. As Jerry said, my name is Caroline Millier. I am a resident fellow in Finance, Insurance, and Trade with the R Street Institute. So the Department of Labor oversees laws and regulations surrounding 401ks and other retirement plans in the United States in conjunction with ERISA, which is the Employee Retirement Income Security Act of 1974. Fiduciary responsibilities are outlined in ERISA for the administration of 401k plans, which are rather stringent. They operate under a prudent person standard, which requires investments to be selected solely for the financial benefit of the plan holders. According to ERISA's language, the prudent person standard is the highest standard known to the law. ERISA tells fiduciaries to show, quote, the care, skill, prudence, and diligence that a prudent man would when choosing investments so as to minimize the risk of large losses. That's certainly rational and fair. So the issue of 401k investments in alternatives, particularly private equity, came up several years ago with the Department of Labor. In response, the Department of Labor issued guidance in June of 2020 via a letter stating that investing in alternatives, and specifically in this case, private equity funds, would not be in violation of ERISA, but additional prudence would be necessary considering the varying factors at play, some of which Jerry discussed, including the typically longer investment horizons of private equity, the difficulty in providing accurate valuations, and the illiquidity of such investments. A follow-on letter was released in December of 2021 by DOL with the intent of clarifying that the department does not endorse or recommend such investments, but simply states they are not in violation of ERISA and they still must follow the prudent person standard. It further noted that the initial guidance was in response to fiduciaries who manage both defined benefit and defined contribution plans, and are therefore more likely to be qualified to evaluate private equity investments. The letter specifically cautions against application of the letter outside that very specific context. While technically not illegal, regulatory burdens exist to dissuade 401k fiduciaries from investing in alternative asset classes, primarily via threat of lawsuits, should an investment fail to provide sufficient returns or provide a loss, or in the case of excessive fees or conflicts of interest, which is often the case for the lawsuits that occur in 401k plans. So that's some of the major regulatory burdens that we're looking at now for investments in alternatives for 401ks.
Yeah, thank you, Caroline, and appreciate you digging into the regulatory thicket there. There's quite a lot there. Well done. Jesse, would you like to tell the audience what is Prequin, and then give us a sense of the market size and the performance of these asset classes that you've been looking at pretty closely, regularly?
Yeah, absolutely. And first, Jerry, Caroline, and the rest of the R Street team, thanks for having me on today. Definitely a very exciting topic, I think, for me and everyone here at Prequin. For any who weren't previously aware, Prequin is the global leader of alternative assets data. It's a rather, as Jerry stated, not very transparent market. So we have a proprietary database covering fund managers, investors in private equity, private capital, and hedge funds, as well as tracking deals and performance for these funds. My name is Jesse Fay, so I oversee our private capital data set for the Americas, in charge of kind of data quality and content, and making sure we continue to grow and improve our data coverage there. So setting the scene, I'll break it into two different areas for alternative assets, looking first at private capital and then in hedge funds. So private capital on a global scale, it's a $10 trillion industry as of the start of this year. When I say private capital, I'm referring to private equity, private real estate, infrastructure, private debt, and natural resources. Of that grouping, private equity is by far the largest, with around $7 trillion in AUM, followed by private real estate is 1.3 trillion, private debt is 1.2, infrastructure just under $1 trillion, and then lastly, natural resources at around $200 billion in total AUM. So a very large pool of capital overall, and one that's grown quite significantly over the past decade and last 20, 30 years. In fact, the industry has more than tripled since the start of 2012, going from a $3 trillion industry to the current $10.6 trillion figure overall. And that's growth that we absolutely expect to continue over the next 5 years. We at Prequin are actually projecting the overall private capital industry to hit $18 trillion by the year 2026. So compound annual growth rate of nearly 15%. And the increased access to retail capital is certainly a key part of that equation. And it's one I know that many alternative asset managers have been eyeing very carefully. That doesn't even factor in hedge funds, which we're expecting to add roughly $1 trillion in AUM over the next 5 years, bringing it to a total of $5.5 trillion and making the total alternative asset space a $23 trillion industry by the year 2026. So what's driving that growth? One very important driver there, as I'm sure you could expect, is overall performance for alternative asset managers. Depending on the asset class, risk return profiles can look very different. So it is a little bit difficult to do a complete apples to apples comparison with the S&P 500 or public equity index. But I think I could break it down using kind of 401ks as a good frame for this. So I'm going to look at two track records here. I'm going to look at the 08 to 2021 track record, and then 2001 and 2021. So basically, two of the last bull cycle runs. So let's look at 08 to 2021. And we take a 401k contribution. Right now, the max 401k contribution is 20,500, or at least under a certain age is 20,500. So if you were to take that and put it fully into an S&P tracking portfolio, that would have grown over those 14 years from 20,500 to an $89,000 investment. If you take that same capital and instead put it into an average private equity tracking benchmark, that would have raised to $106,000 overall. Venture capital probably to $101,000. And actually, if you looked at a full U.S. private capital equally balanced portfolio, it would have came in at $86,000, which is actually just short of what the S&P returned over that same time frame. I know that seems to go against the argument that private capital is a great alternative to the S&P, but I think you should notice that I said the time frame here is 08 to 2021, which is the full bull run. Obviously, this year has been quite difficult for anyone who's had some heavy exposure to equities. And I think where alternatives really shine is how they can shine through all cycles and have downside risk and high risk adjusted returns rather than just total performance. If we stretch that back instead of from 08 to 21 to 2001 to 2021, we now have that same $20,500 contribution. If you had the S&P 500, it would now turn into $115,000 overall, roughly. If you put that money into private equity, or if you put that money into private equity and it followed the average returns over that same time period, rather than the $115,000 you'd get with the S&P tracking portfolio, you'd instead have $244,000 in your private equity portfolio. And if you looked at North American private capital, that would have grown to $154,000. So as you can see, there's definitely downside protection with the overall private capital portfolio, and the upside is much, much higher with private equity, with the chance to quite outperform public equities overall. The impressive performance is leading to more and more institutional investors diversifying into alternatives, and those who are already invested are starting to take larger and larger stakes as they become more sophisticated, showing really the value of alternatives in a long range, well-diversified portfolio.
Yeah, thank you, Jesse. That was a great walkthrough. Now, you mentioned that the general term alternative asset classes includes several components, notably private equity. You mentioned natural resources. You mentioned real estate, and a couple of others. If you put on the hat of an institutional investment manager, how do you view those different categories, private equity versus natural resources versus real estate? What are the considerations that would lead one to go into one of those versus another, or all of them in the interest of diversification? If you can get a little bit more granular within the term alternative.
Yeah, of course. You know what? Rather than give my own opinion here, I'm going to steal an opinion from someone smarter than me. David Swenson, who unfortunately passed last year, but he was the former portfolio manager for the Yale University Endowment. He took over the endowment in 1985, at which time they had about $1 billion in AUM. He was an absolute pioneer in the space. He wrote several books. And today, the Yale Endowment has over $42 billion in assets. And of that, 80% of their target allocation is towards alternative assets. So he created the Yale model, or the endowment model, which is a long-term investment strategy, which has a few core tenets in it. First, diversification is key. You need to take your wealth and put it into different buckets in order to weather different market conditions. He argued that fixed income and commodities don't provide strong enough long-term returns compared to the diversification advantages they provide. So he says you need to look elsewhere from fixed income and commodities, as you said, which are two of the important big three in traditional investing. And then lastly, and something controversial at the time, he said liquidity is expensive. So unless there's an immediate need for capital, liquidity is going to weigh down your overall returns. So it's better to look towards longer term investments, which will provide a better return on average. I think one of the most important investment options for 401ks right now are target retirement funds. which invest in a mix of both domestic and international equities and fixed income. And basically, they increase allocations towards fixed income the closer you get to the target retirement date. Compared to the Swenson model, that doesn't offer nearly enough avenues of diversification. And it's too heavily weighted towards fixed income, which, as we already said, is going to bring down your overall returns. So instead, let's look at what professional money managers at an endowment, foundation, or pension fund are considering. So right now, 96% of institutional investors include at least one alternative asset class in their portfolio. Of that group, by far the big one is private equity. 70% of institutional investors invest in private equity. When they're targeting private equity, what they're really looking for, they want high risk-adjusted and absolute returns for their portfolio. Real estate is the other big one, with 65% of all institutional investors, including real estate in their portfolio. With their real estate investments, they're seeking an inflation hedge as well as a reliable income stream. Hedge funds is a bit of a wild card. 44% of institutional investors invest in hedge funds. That used to be a lot more popular in the early 2000s, but it's taken a little bit of a hit in the last 10 years. Hedge funds is very dependent on the strategy, but largely high absolute returns and a low correlation to other asset classes are what these money managers are targeting when they invest in the hedge fund industry. And from a good hedge fund, they're really expecting someone who can perform through all market conditions. Natural resources has about 37% popularity with professional money managers. People who are investing in natural resources are looking to reduce their correlation to other asset classes, as well as an inflation hedge. And then private debt and infrastructure both have 35% of all institutional investors investing in those asset classes. Private debt, which is an industry that's really taken off in the last decade after the GFC. What they're looking for there is high risk-adjusted returns, as well as a reliable income stream. And for infrastructure, it's very similar to real estate for these managers. You're looking for an inflation hedge and also a reliable income stream. So as you can see, while they all have different risk-return projections, they each provide something unique, and depending on where you are in your investment thesis, or if we're talking 401ks, where you are towards retirement, they all have their unique benefits which they can provide for you.
Yeah, thanks, Jesse. And I'm glad you mentioned the Yale model, the endowment model, and David Swenson, because one of my good friends went to school with Dean Takahashi, who was Swenson's partner there and pioneered that model, which, as you said, generated those fabulous returns. So that was a good treatment of the different classes there. Now, that was all sounding very sunny so far, but let's just turn now a little bit, Jesse, and talk about some of the points of opposition. There are concerns on lower transparency because private corporations don't disclose the way the SEC requires with 10Ks and quarterlies and all that. So less transparency, and there's lower liquidity. Private equity firms hold on to their portfolio companies for 5 to 7 years. So there's less liquidity there with pure private equity. The limited partners tied up, the investors tied up for that period before they can see their money. And there's higher fees also involved, the 2 and 20 rule, and the risk, the higher risk, which I think has caused DOL to take that view that they've taken on these kinds of investments. Do you want to comment a little bit about some of the points of opposition or obstacles to getting people more interested in supporting the introduction of more alternatives?
Yes, I'd be happy to. I guess I should preface it. I know before our capital puts anything, or our street puts anything out, say if it's a partisan spin or not, I'm obviously pro alternatives. So, bake that into the equation here. But I think for the large part, many of these fears are a bit overblown. First, taking fees into account, I think this is one of the most publicized issues with alternative assets, is that they're very expensive. And is it worth it for the amount you have to pay? You already stated 2 and 20 is kind of the model for alternative assets, that being a 2% management fee, which is what you pay annually based off your AUM within the fund. And then 20%, which is a performance fee, which is the amount you're paying for any profits that the fund managed to generate for you. So you can already see, it's quite an expensive, asset class to break into, versus a mutual fund, where I think the average expense ratio is between 0.5% to 1% to cover the overhead costs. So obviously much more expensive. But I would argue it doesn't really matter, because on a longer scale, alternatives are still outperforming in the long run. At Prequin, we only post returns net of fees rather than gross. And over the previous 20 years from '01 onwards, the only alternative asset that underperformed the wider US equity market was venture capital, which was because the dot-com boom hit it so hard that it took a while to recover. In the last 10 years, venture capital has actually been great. So even though you're paying for this performance, the important thing is you're getting what you pay for. So even though you're paying 2 and 20, your fund and your funds are still going to be doing quite well. For liquidity, so there's two general buckets: hedge funds and private capital. So hedge funds are a bit more liquid. It varies based on the fund, but generally you can redeem capital at a quarterly or annual redemption. There's some hoops you have to jump through, but generally you can pull it back if need be. Whereas private capital funds, on the other hand, have a general lifespan of between 8 and 12 years, and they're starting to actually veer to the older side of that spectrum. However, we're talking about 401ks here. 401ks are retirement accounts. There's already long-term investment horizons, and that should be baked into the equation by default. With a 401k, you can start withdrawing funds at 59.5, and you're required to start taking minimum distributions at age 72. So the current recommended strategy for someone at this stage in your life would be to reduce risk in their portfolio and start taking on more fixed income, which is, according to David Swenson, a very expensive way to protect your capital. Instead, we have strategies like real estate and private debt, which we have professional money managers targeting to produce solid income streams for retirees with a much better return profile. Pension funds right now, public and private pension funds in the US, they allocate between 15 to 35% to alternative assets on average. And I think that's a great case study for how a late stage 401k can effectively use alternatives to meet a person's retirement needs. So yes, I think holding periods and liquidity is something that needs to be taken into account. But if we're talking retirement, it should not be the one that's leading the conversation here. Transparency, I think is actually a very interesting one because on one hand, currently alternatives is restricted to accredited investors who have the capital to sustain a loss, but also are supposed to be a little more educated in terms of how alternative asset funds may perform. So it would increase transparency help your everyday investor in a 401k, or would that be more confusing? So I think that's something that regulatory bodies really need to take in and make sure they set up the right guardrails in order to protect investors here. I'll point towards ILPA, which is a organization that is basically supporting institutional LPs and almost unionizing them to push for greater change and a push for transparency within the alternative assets market. They set up a statement of private equity principles, basically saying that ILPA members will only invest in a fund if they can meet certain transparency metrics and report by ILPA guidelines. I think that is a great first step, and the industry has been moving towards greater transparency. But I think with the federal government behind it, there's definitely a will to bring in retail capital. So I think transparency can still work towards that and improve, and something that I think with the right discussions with the government could definitely be put aside. And then I think the last one you mentioned was overall risk. And I think that's a legitimate issue to have and a legitimate conversation to have about should 401ks be allocating towards these funds or not. I'll use buyout as an example here, since it's the largest overall strategy by assets managed, leveraged buyout funds, private equity. Now, personally, I do think the benefits outweigh the costs, as median average returns for private equity are generally quite strong, but the downside risk is much higher, which is why the current restrictions are for accredited investors only. We actually recently put out a report on persistency and returns for the private equity market. And as part of that report, we took a look at buyout returns from 1980 through to 2018. In the private capital industry, we tend to look at performance in terms of quartiles. So their top 25% of performance, we'll call that a top quartile fund, followed by second, third, and then finally bottom quartile, fourth quartile performers. So in this study, we did a review of private equity returns over the last 40 years, and they returned an average IRR, or internal rate of return, of 35.8%. And that was for the top performers. However, the bottom quartile performers returned an average IRR of only 1%. So that's nearly a 35% delta in returns between a top manager and your bottom managers. And that's on average, which means that on a 10-year timescale, an IRR of 1%, that's already severely outperforming probably fixed income as well as certainly equities. So you'd be losing money there, but some of these actually were negative. So you end up losing some of your initial investment. So a 35% delta, it speaks to both incredible outperformance if you pick the right manager. But one reason Yale was so successful is that risk management is very important, and you could underperform the wider market or even lose money if you aren't careful. So I think one of the biggest hurdles for the government and regulatory bodies to climb is how do we protect consumers from funds which are overly risky and make sure that they are guided towards the right managers without being overly selective, where you can actually bite into some of the outperformance which is possible invested within private capital. So overall, I think it's still highly positive, but there's definitely some work to be done to make sure this is safe for everyday investors.
Yeah, thank you, Jesse. And for the audience, if you have questions, please type them into the question box at the bottom of your screen. And thanks also for mentioning some of your research. I've looked at it over the years and benefited from the reports that you've produced. And speaking of reports and research, R Street has put out a two-pager. It's not as long as some of your reports, but it's a two-pager available on our website on this subject we're talking about today. If you have any trouble finding it, you can email me or Caroline. Our emails are on our website next to our pictures, so you can identify us. But Caroline, I've been hearing from what Jesse was saying about some of the investment areas, particularly infrastructure and real estate and natural resources, that this is something that doesn't just affect and is a potential benefit for the assets of individuals, but also broadly, because our prism, the way that we view the world in policy, is what's good for the country, what's good for the U.S. economy, what's good for states and for working Americans everywhere, not just those with balances in these plans. And it occurs to me that just as the role of the investment industry, or one of the activities of the investment industry, is investing $11 trillion in corporate bonds and municipal bonds, and supporting the economy by buying bonds that allow the building of bridges and tunnels and roads, that these kinds of investments are also giving a boost to the economy. Do you have any thoughts along those lines? What the impact of having more investment in these kinds of classes are on the U.S. economy positively, the way, if I'm seeing it right?
Yeah, I mean, certainly, opening up these asset classes to additional investors and additional, streams of revenue or not revenue, but investment is hugely beneficial. And not just, I would say, not just, for the broader economy. You could also consider kind of the government implications as well. So if you allow these alternative investments, you have the capability to give Americans a larger nest egg at retirement, which we've discussed, but you're also allowing them to reduce the risk of outliving their retirement savings and simultaneously making them less reliant on Social Security, which is, continues to be a big problem, the solvency of Social Security. So I would say that the benefits are huge, and allowing Americans to be able to pool their assets to invest in something that they may not have the capital to invest in on their own. And I certainly understand the issues with the risks, but investment is risk, right? So and it would be what people are kind of comfortable with. So as 401ks are structured now, typically they advise people that are younger to invest in something that's a little riskier because you have a longer investment horizon, right? So you already kind of have your specialized way that you invest your 401k assets, and you get to pick kind of, your risk appetite. And like I said, often based on age or different factors. So, it's just giving the option. It's not saying, hey, we're going to start investing 401ks and alternatives. And it's something maybe people are wary of, or they don't understand necessarily. But it's giving people the option to be involved in a sector of the economy that they've been excluded from. So I think the benefits to both the individuals and the broader economy are huge, the potential benefits.
Yeah, thanks. A great answer, Caroline. We got a question that came in from Oren. We're running a little bit short on time, so we're going to get back to you in writing. Sorry, we're not being able to get to you, because I did want to close with a recent development in Washington on the policy front, which Carol and I follow pretty closely. In July, just a couple of months ago, Pennsylvania Senator Pat Toomey started speaking about a Retirement Savings Modernization Act, which would propose diversification of retirement accounts, something that would increase retirees' financial security, which resonates and harmonizes with what we've been talking about this afternoon. And I think there may be more of a tailwind to support this kind of development, because the increases in private investments happened a couple of times in the last few decades. One in 1973, 1974 was a crash for the stock market. It went down by 45%. So after 1974, and that's why ERISA was founded. That's when it was formed, 1974, really to minimize the kinds of losses from there, to increase the fiduciary standards. But there was a big increase after 1974 in private equity, not just at Yale University. And then after the great financial crisis, 2008, 2009, we saw in its aftermath, again, an increase in the involvement in private alternative asset classes. And now we've seen so far from the peak in March of this year, the S&P 500 has gone down 18%. So it's not 45% like we had in 74. That was a pretty wild swing, but still it's pretty substantial for those that are suffering from that. So I think there's a bit of a tailwind to move this and at least start the conversation, to talk about the issues, to talk about the pros and cons, and to present the information in a data-based, factual, objective way, which is what Jesse and Caroline and I endeavored to do this afternoon. And we thank you for your participation. Thanks for spending time with us. We look forward to getting your questions, and we'll revert to you via email if you want to send those in. The chat box will be closing in a few seconds, but we're always available by email. So thank you, Jesse. Thank you, Caroline. And thank you, members of the audience, for being with us today. This is Jerry Theodoro signing off. Thank you.
Thanks, Jerry.